Good morning, everyone. Great to see you all here this morning. My name is Alex Fraser. I am director at Viridian, and we work with entrepreneurs, hubs, and angel investors across the continent. So we've worked with lots of angel investors. I'm an angel investor myself, and I'm a reformed venture capital investor. Maybe one day I'll go back there again.
Good morning. I'm Adham Azdam. I come from Cairo. I'm a second-time founder of a fintech company. Used to work for IFC before, and I'm also angel investor on my own terms.
Cool. Morning, everyone. My name is Hope Ditlakanyani. I lead a team that sources deals across the continent for Founders Factory Africa. We have a portfolio of over 50 startups across most of the major markets across the continent, and excited to be here.
Hello, good morning, everyone. My name is Lori Fuller, not Muller. I am not yet a reformed venture capitalist, but maybe that's coming. I'm an LP with Launch Africa. I'm also a venture partner with a global early stage fund called Raven Capital. And then lastly, as part of my role as an ecosystem builder, I'm also an executive coach and advisor with Stanford University based in East Africa.
Fabulous. Okay, so as you can see, we have individuals that are exposed to a lot of founders. We have a founder perspective from Egypt, which is one of the fastest growing and exciting market on the continent. I would probably want to kick off the conversation by, asking, especially from an investor perspective. We're talking about downturn. We're talking about a change in the perception of capital availability, the future of the market. What are you seeing as the needs of the entrepreneurs, and what is your experience interfacing the entrepreneurs right now when it comes to the needs, when it comes to the conversations? Lori, do you want to start? Should we start from you?
Sure. No, I can start. I think it varies based on the type of entrepreneur. All of them, obviously, we advise look at your cash position, understand what you have, and think about reframing that amount to last for a longer runway. So that's the first conversation we have with all of our portfolio companies. However, there are others who are really able to take advantage of this situation, and I think this may be something we talk a little bit more about around making acquisitions. So I'm currently advising a fintech right now that is about to acquire a business that was always part of his strategy, but now he can do it sooner and for a lot less, and get not only the platform, but a lot of great resources and brand behind it. So I think it's looking at whatever opportunities exist for you, but being very realistic around how long your cash runway will last and what do you need to do in order for that to happen.
I can add to that. I think at Founders Factory, there's maybe two broad things that we're seeing. The first is, to add to that, obviously, it's always reassessing your cash position, but making sure that you build strong fundamentals in your business, right? And I think we've had extensive conversations with our founders as to what are the right indicators to look for towards that product market fit. And instead of founders focusing on things like customer acquisition and revenue, how many of those customers are actually active? How many of those are you retaining month on month? How does that translate to good unit economics? And I think for us, it's a firm belief on building those solid fundamentals. In the long run, will build that sustainable business. I think the second thing that we are picking up, though, and it's quite an interesting overall topic, is there is also an increasing need for debt, I think, in order to kind of finance a lot of the growth and expansion, particularly in markets where the founder needs to lay that infrastructure themselves. And I think it's consistent conversations within VCs, but with other sort of institutions as to how we can collaborate on blended models in terms of really powering up that growth. And I think we see it in the fintech space, the e-commerce space. Just if you're tapping into new markets, there's always a need for equity and debt in order to power up that growth. So it's a lot of the conversations that we're having with our founders right now, especially in these times as well.
Alex, would you like to?
Sure. So I think back to Laurie's point, it really does depend on your market and it depends on your sector. So I think in markets where there hasn't been this massive explosion of capital and there are more kind of frontier ecosystems, capital is still quite conservative in terms of wanting to, there's not as much FOMO in those markets. You know, if you are investor maybe in Angola, in Luanda, you know, you might be looking at what's happening in Nigeria, but you know, you might be looking at quite different fundamentals. I think from an angel perspective, they are wanting their businesses to, again, be quite cash conservative, really prove those fundamentals, as you were saying, Hope, and kind of get some early successes and traction. And then really trying to tap into angel networks, you know, to tap into their connections, make introductions for their founder companies, encouraging their founders to then move into other support programs where they can access additional capital. So I think there's a much stronger focus on leveraging your networks and your ecosystem and using the resources that are there.
So just to summarize a bit, we have the return of the EBITDA. I think there was a meme on Twitter a few weeks back. They were like, the VC found this new word, EBITDA. And it's like, they were all like a meme of someone who's mind blown by this. And so there's a return to the fundamentals, as I was saying. They're trying to really look into your network, trying to really look into who can deliver value. And as Alex is saying, there has been a little bubble, little more or less, spreading across Africa and across the tech space. But we're looking at 54 countries, and many of these countries haven't had the chance to access all this capital. So when we're talking about a change in direction for the capital availability on the continent, we're not necessarily talking about a dramatic shift in like scenario for many countries. We're talking about maybe a slowdown of the overflow in capital that we've seen in 4, 5, 6, 7 markets across the whole continent. But before we move on to kind of conversation on challenges at late and early stage, I was having a conversation with Adam this morning. Adam is a founder, and he's recently raised. So he's actually he's been able to mother through the what is going on right now, and then probably can offer another perspective, maybe a counterintuitive perspective.
Actually, this is, I think there is not a one-size-fits-all today in the startup world. While established startups have maybe a bit more of a challenge to raise growth capital, there's still actually capital for building. And actually, this is a very exciting time to build. Because when you have a crisis like this, you have a market that maybe comes back more to fundamentals. You cannot just throw money at it and it will work. You have to come up actually with interesting things to build and interesting solutions and smart solutions. And I think for building things, there is still capital on the market. And for building, for early growth, or for early stage startups, there is still capital on the market. But it is capital that goes to really good founders, maybe second-time founders, de-risking. And that's what we saw. We saw a lot of focus on the quality of the project, but also on the quality of the founders at that early stage. So we are the antithesis of this, because we just closed actually last week with an oversubscribed round in this environment, which we were very happy about it. But this is something that is I think is still there for early stage startups. There is still a way here to do things, and you get protection because you are protected against those who might be crazy and just throwing money at it for a while. And I think this is for the next couple of years. There will be this protection. There is also protection when you are in your home country. Maybe those startups who have less growth money today in other countries are not going to come right away in your market. Maybe they had plans. Actually, for Egypt, for example, where we are, there were big startups coming from Nigeria that had plans to come into Egypt, and these plans have been delayed a bit. So this is good for us because on our home market we can build now. This is an exciting time to build.
Thank you, Adam. I think maybe using the word capital drying up isn't as accurate as maybe saying paralyzing or freezing, because many investors are now kind of waiting and seeing what the situation might look like. And as a matter of fact, we've just seen, maybe it is an outlier, but Yassir in Algeria just raised $150 million for a business that's been around for a long time and probably has been looking to scale for a long time. So yes, our Money Fellows raised another 30 million. We have seen
Maksab Maksab also in Egypt. So.
Right. So we have seen companies being able to access capital. As a matter of fact, a lot of people are talking about how capital is stacked up in there's a lot of dry powder out there locally in Africa and internationally. So if we can look at the different size and stages of the ecosystem, what do we see as kind of the challenges for, Hope supports pretty early stage companies. Alex is driving a whole community of angels across the continent, and Lori has got access to the American perspective where kind of investors come into the continent and deploy late stage capital. America still represents the kind of country of origin for investor that deploys the highest amount of tickets and the highest sort of volume of investment on the continent. So what are we seeing as being maybe the challenges, the late stage versus early stage? Maybe Hope, if you want to kick this off.
I think despite the current times that we find ourselves in, it's always been challenging on the continent to kind of move from seed to Series A and then Series A to even subsequent rounds. I think, as he mentioned, growth stage capital still isn't coming in the numbers that we need in order to sustain the growth at those levels for the continent. So I think that has always been a challenge. So I don't think that part has changed. But I think what is happening now is there is a delay in a lot of funds in terms of distributing capital on that early stage. So we are seeing then more issues from getting to pre-seed and seed, and then you're seeing like a pre-Series A and then pre-Series A, etc., because it's taking longer for people to kind of bridge the gap between a seed and a Series A than the traditional times. And I think a big part of it, hence the return to the fundamentals, is when people look under the hood, right? So you can have this high growth GMV, but what are the margins that are translating from that, and what do you keep? You can have 1 million customers, but of those, how many are actually active on a month-to-month basis? How many of those are you losing? And I think because you can't raise more money, then you can't necessarily acquire them through marketing or other channels that traditionally in the bubble we existed in, you were able to do so. So I think there is definitely just in the early stage a much more deeper focus on due diligence, and that due diligence is really, are you building products that people love, right? But I do think in general, as an ecosystem, we need to continue to attract that growth stage capital because we aren't raising enough of the Series A, Series Bs. And I think that's just a general non-market downturn factor for the ecosystem currently.
Thanks, Hope. Alex, you've got a lot of exposure to angels. I believe you've been running a training program for now a couple of years or more. What are the conversations happening when incoming investors, incoming angels, or angels to be approach the conversation about starting to invest?
Thanks, Dara. So I think in the past few years we've seen a lot of VCs and or early VCs start to actually play in the angel space, and I think that is probably going to change. So rounds are being kind of filled really quickly. The due diligence kind of happened very fast, which is not a bad thing, but sometimes fast doesn't always mean thorough. So I think angels are having to play a greater role in terms of collaborating with more groups, kind of raising matching funding, and kind of almost being less of a participant into a round and having to start actually driving around in companies they believe in. And then really looking at their portfolio of companies and needing to do what VCs have always done, which is you can't invest all your capital and then not have any for follow-on rounds. So you need to have some follow-on funding to be able to really support those businesses who need a little bit of extra capital to kind of get to that seed stage, or get to that Series A, or even just take, cover a burn rate when a due diligence that you thought was going to take kind of a few months, 3 months is now taking 6 or 8 months, or you need to spend some money on getting ready for a proper due diligence and becoming like fully compliant. So those kind of things are really becoming more apparent and just taking a little bit more time and care, and that often translates into needing more capital.
Thanks, Alex. Laurie, are you, maybe you're not, but but are you
pretend.
talking to investors from, you collaborate with Stanford Seed. Are you seeing American investors being a bit more skeptical about funding, or are you seeing kind of the current trend being simply a slowdown and a rethinking of the strategy that investors have?
I think that there's macroeconomic impacts, but the degree of that impact is different quite significantly by area. And so I think the risk is that an American investor or European investor brings their specific situation on their continent to a different continent. So I do spend a lot of time trying to make sure that people that are interested in investing in Africa, are understanding the impact to Africa. GDP does look good, relatively speaking, compared to other areas. And so there is growth and, there is opportunity. My personal belief is that the later stage investors might be more skittish because the stock markets are down, the value that they can acquire in public stocks is quite significant, interest rates are going up, there's alternatives now for the cash. And so I think early stage, might be less affected because they have time on their side based on that investment, and it could be a smaller amount, obviously. And so I think that, probably less concerns there, but I think the later stage, there's a lot more options of where you can put your money. Just as an aside, Adam gave a pitch, and it was, I thought, really apropos. He did not use any slides. And so the point is, if you're really confident, you don't hide behind slides. You don't have to, right, as a founder. It's same here, right? Now cost of capital is much higher. There's less of it possibly. And so, we're pulling back the curtain and seeing exactly how these startups are operating. So I was thinking of you because if you don't have slides, you can't hide behind them. You have to sell yourself and sell your idea and your business. So I was really impressed with that, actually, as an aside.
Thank you, everyone.
Didn't end up investing though.
So I kind of want to move towards the alternatives and the diversity of the capital offering across the continent. So we're talking about VCs maybe again being a bit more skeptical and waiting, and not rushing into deals. We have Hope here, who works at Founders Factory, and Founders Factory has been partnering with corporates for a long time. And something that I'm seeing as the conversation evolves in the ecosystem is a shift towards not necessarily looking at VC as the only route to growth, but also the alternatives that are out there, such as corporates, such as the work that DFIs are doing, such as exit routes that are not necessarily IPO driven. I'd love to hear more about what the use cases for corporates are, what like the interest is for corporates to enter the startup world.
Yeah, so for context, as Dario mentioned, so we are corporate backed, but we also have a specific team that focuses on brokering relationships between corporates and startups across the continent within our portfolio. I would say, there's 3 different types of use cases I've seen for startups to benefit from corporates, and then I'll talk about what's in it for the corporates. So the first one is, particularly when I talked earlier about that liquidity challenge, that yes, equity is the most expensive form of financing debt books if you're going to be giving working capital to SMEs or you're trying out a neobank. So obviously there's a need to kind of access debt at cheap rates, and mostly that debt is sitting at a lot of the institutional banks, as an example. So one of the ways that I've seen, particularly in fintechs and e-commerce startups, is how can you leverage that existing balance sheet that sits with banks in order to on-lend, right? So that's one of the kind of partnerships that we've been able to broker, to say, hey, stand big, one of the biggest banks across the continent, and how do you work with a lot more fintechs who have access to markets that you can't tap into or serve economically as well. The second one is, and particularly if you look at the telcos on the continent, they have unprecedented access to distribution. So a lot of the consumers in the continent, right, through penetration of mobile money, etc. And we've seen interesting use cases of how they're partnering with startups in order to extend their reach, but also for startups to actually deliver their products, whether it's in agri-tech, whether it's in health as well. We have Zuri Health in our portfolio company, which is quite an interesting model to deliver healthcare in an affordable way. And then the last part of it is, how do you also leverage the brand equity that corporates have? Particularly, we know in the African market, the biggest barrier to that digital adoption is the trust. And I think because corporates have been there for tons and tons of years, right, they have that brand equity in informal markets. So how do you leverage that brand equity to extend your reach? So that's, and I think for the corporate, there's 2. One, they're increasingly looking to remain competitive, that M&A pipeline. So even our interesting partnership with Standard Bank, they've started to then directly invest in some of the startups in our portfolio, because obviously these startups are giving them access to new markets, giving them access to technologies that allow them to serve specific markets more economically, access to new models of, for example, credit rating systems using alternative data sources that they don't have that data to build that credit scoring algorithm, but the startup has through playing that aggregation front. So I think that access to new markets is one big thing, but also just general learning as well. I think they're also on their own trajectory of what does this new world mean, what does the impact of blockchain mean for us, and I think exposure to working with startups directly, you get to kind of understand the implications of how it affects you as a bank, as a telco, in terms of where the world is going as well. So it's not easy because they move at different paces, have different incentives, but I think it's interesting when investors play that role of brokering those deals, because we obviously have the benefit of being able to bring everyone to the table as well. So it's interesting. I expect a lot more corporate-backed venture funds to be launching, but it's not an easy journey, but I think it's definitely needed across the continent because they're sitting on tons of liquidity.
Thank you. I just wanted to check how long we have, if we want to leave a few minutes for Q&A. Sorry, Alex,
I wanted to just add, if we've got time, to Hope's kind of comments. So I think what's really exciting is, I'm always amazed, just as there almost are infinite numbers and types of businesses, there are actually so many more financing options. And I think many entrepreneurs just think angels and VCs are the only funding option out there. And the reality is not all SMMEs are startups, and not all of them are VC and angel. Some might be angel fundable, but they're not necessarily fit the VC model. And it's really exciting to see all the alternative sources of funding and funding models that are emerging. So we're seeing kind of, especially if your business is addressing an SDG, we're seeing a lot of grant capital. we're seeing capital in terms of revenue-based financing, which is almost venture debt. I think Untapped Global is doing some quite interesting thing where they are debt financing for productive assets, which is interesting. So I think as a you know, and you need to also understand your business and your business model, just to understand what kind of funding do you need for what portion of your business. So whether you need to raise a debt book for loans, whether you need some infrastructure financing, whether you need to buy a number of assets. So I think that also is something startups need to become a lot more aware of, and just become generally aware of. It's not as kind of binary as people think, like it's VCs or the bank. I think there's lots of financing options in between.
If I can just add on to that, I absolutely agree. And one of the things that I mentioned yesterday is when we get a pitch deck from a startup, what are the uses of funds? You know, if you see a large percentage on inventory or working capital, you know, that makes you nervous, right? Because that's not necessarily where you want, to your point, expensive equity to be going. So it is very important to really understand that for different types of assets, there are other options. And even if you want to go the traditional venture route, it's also good to make sure that you can apply any investment that you're going to get to those assets that are going to really enable you to grow quickly. And sometimes the working capital isn't necessarily the preferred use for that.
Yeah.
Thank you. I personally think I wrote a few words the other week about it. Actually, I think the ecosystem is reaching a stage of maturity where people are asking the right questions. People are starting to ask the returns to funds. People are starting to ask whether companies in Africa can actually at scale feasibly become IPO companies in the American stock market. There's a normalization of the different type of contract. There's a normalization of now the EBITDA and the fundamentals. Hopefully it's kind of an adjustment that is set to benefit the ecosystem. As Adam said, like, there is money for who's building, and there is money, and there's always been money for organization that, like, whose balance sheet makes sense. Maybe this organization may not be as early as, like, non-revenue generating and be too experimental, but money is there to support who is building and his proven track record. So I think we'd love to open up the discussion to the audience. I'm not sure how long do we have. Guys, how long do we have for the Q&A? 5 minutes Q&A. Cool. Should we do a round of hands up and then we'll call? Cherney over there.
Shane, do you want a mic?
Hi everyone, good conversation. I mean, return to fundamentals, you talked about EBITDA, Dario, and I think Laurie, the global, environment is really challenging right now. We think there's a lot of dry powder out there, but that dry powder is being navigated in the sense of making asset allocation decisions across various classes of assets, right? We're in an environment of US Fed tightening. We've got really bad news coming out of the crypto space with the FTX seizure, right? Second largest asset seizure historically. And I mean, FTX is invested in the likes of Chipper Cash. So there are major follow-on repercussions. And as a VC now, your hurdle rate is going to be higher for much longer. Laurie, specifically, what are your thoughts just around, the vulnerability of all growth stage companies and their ability to kind of raise potentially bridge financing so that they have a little bit more forward cover And as an LP, how are you thinking about this in terms of, timing? How temporary could this be, or should we be facing something that is going to exist for much longer?
Well, I mean, it's a great question, and clearly every day there's new information we're hearing about that kind of sets us back, and to your point, forces us to analyze, okay, what else is really going on in the, in the broader ecosystem. I think we haven't really talked a lot about this, but let us not underestimate mergers, acquisitions, right? I think this is another way that we can think about growth opportunities kind of at some stage for companies. Also, private equity could be interesting here as well, right? I mean, they may come in and see some opportunities and go a little bit more downstream as well. So I think it's just, keep to the basics, keep to the fundamentals, but be open to more options now, because some of these traditional options may not be as easy to, and then sometimes, and this may get me in trouble, but maybe this is the converted, VC, don't always listen to what investors or venture tells you, right? Because at the end of the day, what's most important is, if you have to slow growth down to have a business still to grow more quickly in 2 years' time, in 18 months' time, that's better than to not, take those severe cuts now, because if you don't take them now, you may not have a business later on, right? And so, we're always, I'll speak for myself at least, just in general, we always want more, right? But there's also, with these times, there's also some guidance to say, you know what, this is what I need to do. And if you do need to make those big cuts, make them now. Bill Gurley just said recently, right, the cultural negatives of a 5 to 10% cut can offset, any perceived benefits of a slightly lower cost basis. Just do what you need to do. Keep the lights on, and then when we all come out of this, hopefully there's a real opportunity for the upside.
And frankly,
If I may add to this.
oh, sorry, please.
If I may add to this, I mean, from a founder's perspective today, I mean, what's happening in the public markets and the IPOs and IPOs through SPACs in particular, that brought companies, startups into public markets were not ready, and they were slammed. And it's very difficult for a founder or for a group or a project to go into an IPO and a SPAC if they are not ready for it internally as an organization. Needs to be different. And I think today founders are also thinking about it differently. I think IPOs have now less of an approach, or because they saw what an IPO mean and what does it mean to take a company public. And I think today people are more thinking about keeping the companies private for longer. And that means also building them differently, because it means that you have to exit to a strategic, you have to exit to a merger, or you have to be a profitable ongoing business. And just this IPO roulette is not going to function anymore. And that's actually a good thing for everyone.
Yeah, and also, like, frankly, we got hands on. Please.
Oh no, please, you finish your...
No, I was just gonna add that, like, frankly, I always say Brighter is a kind of filter to the ecosystem. Like, organizations come to us, they ask us questions, and then they start deploying cash. And we've actually been working with a lot of organizations in the private equity space and the corporates. So not necessarily VCs. Like, yeah, we're friends with all the VCs, but there's an increasing flow of interest from corporates and from private equity into the space. Private equity, 2 reasons. One, direct investing, and second, fund of funds activity. And then also corporates, 2 reasons. One is M&A activity and expansion, and the other one is actually distribution. We've got AWS over here, and there are like many organizations, global companies that are entering the space, are figuring out that there's thousands of companies that can be users of their products, and they're now setting up shop. And when the when a big organization sets up shop in one of these markets, things kind of start to change. Hiring mechanisms start to change. The flow of money within the ecosystem start to change. The level of resources start to change. So, and that's what I mean when I talk about maturity of the ecosystem. There are all these moving pieces that are happening, all these interesting questions that are being asked. And that's why I kind of have this note of optimism when I end my conversations, because even though it may be too early to assess the performance of funds, because many of these funds are set to 10 years long, and like most of these funds were born like during COVID. So like we're not even halfway through the lifespan of 70% of the funds across Africa. And so we'll have to wait and see what is going to happen. But the fact that all these conversations are happening right now, it's extremely healthy.
Cool, thank you. Yeah, this is Nick Rohani from Vula out in London. We're particularly working with founders on the continent, local founders, and I really like the conversation you were having about kind of alternative funding sources. And you know, I'm just going to be frank here because I think that we're all in this room. It's better to have that conversation. The experience that we're seeing a lot of our founders have around these kind of alternative sources of funding is a bit of being between a rock and a hard place. And what I mean by that is our local commercial banking ecosystems, maybe not so much in South Africa, but in other places, are so used to a particular way of doing business, are so used to a history of extractives, maybe a little bit of telco, maybe a little bit of fintech, but that's it. They want, you know, 5-year balance sheets. They have no idea how to treat a seed stage company, and their requirements are prohibitive. On the other side, so that's the answer for debt. On the other side, you know, we have these DFI funders who, yes, they have money to allocate, but that also comes with so many strings attached, and usually comes with somebody who's overseeing or sits on your board who has never begun to found a business in the first place, who's probably going to start to wind things down at your company and throw it down the drain. And then the third thing is that you have these VCs who have no idea what it takes to actually do business on the continent, who have dislocated expectations of what growth looks like, of the type of capital you have to put up front to build the infrastructure to actually do your business. And you're looking at, you know, clever ways to blend these finances, but you're also blending a lot of the difficulties that come with engaging each of those actors. And so I really like what you were saying, you know, about there maybe we're starting to see a little bit of momentum around local commercial banks. But I'd like to also get your comments on some of the hard realities that our founders face in engaging with some of these alternative forms of finance as well.
I mean, yeah, no, definitely. I think I can share an initial thought on that. I do think that these traditional institutions are on their own learning journey as to like how to keep up with the pace of different startups, right? And to your point, I think we see it in different maturity levels across each ecosystem. Definitely in South Africa, I think the banks here are a lot more in tune with startups. They have their own direct investments. They definitely are trying to become platforms, all of them, right? So then I think the way they think about collaboration and M&A, it's a lot more different than what we see across the continent. I would say East Africa is the next region where a lot of the banks there actually collaborate with startups. Nigeria, very different landscape, 100% agree. I think the banks there are a lot more competitive with the different fintechs and commerce players that are coming to market. So I do think there is different levels of maturity. And to your point, there is a sense of pragmatism that we need to have about what does it mean to actually go to that route and engage a bank. But I think for us at Founders Factory, because we've been on this journey for 3 years now, 3 to 4 years, right? I think we noticed that there is a role that investors can also play, right, in terms of accelerating the learnings, because obviously as a startup founder, to your point, you're in the position where you need something from this, so your negotiation power is taken away. And I think for us in our model, it's always been how do we align those incentives quite well. So as a reference, you know, Standard Bank is an equity investor in our fund, right? And then is that a way to kind of align incentives more deeply, because not only is there a strategic alignment that they get out of it, but also there's a commercial upside from an equity perspective. So I think we're always trialing different models to kind of align those incentives. But to your point, it's a learning journey and it's difficult, and I think founders should be aware of the pros and cons and the impact on timing to market and execution that would have depending on each source that they explore.
Let me comment on this because I used to work for IFC, and very on top of the strategies, there are always SME funding.
But he's not told us until the end of the panel.
And I always saw this there, and we never did it. We could not, because as you said, these DFIs are not built for this. They cannot do this. So what they do is that they put money with commercial banks. But then commercial banks have also difficulties assessing SMEs. Commercial banks have 200 years of history lending to corporates and lending to people, retail. But SME is a middle thing that doesn't work well. Actually, my previous company that I built was a revenue-based lending company. We were doing transaction-based lending. We could get the transactions of the last 12 months and then issue a debt or a credit decision within 10 minutes of analyzing this. But this can only serve one purpose, which can only be short-term loans. This can only be going to stock or maybe a piece of equipment. So the allocation is key. Like revenue-based lending works, but works for a specific use case, which is how to get more working capital for a fast-moving company. It's not there for a larger investment. You cannot do revenue-based lending on a 24-month projection. This doesn't work. You would still need a bank to assess this, and then you come back to the same issue that banks cannot assess SMEs well. I fully agree with, because I built a business actually around this, which works today in the Emirates. And I fully agree on that part, and it's still there. But I think there are exciting things happening in Africa on the revenue-based, on transaction-based lending. I guess we will see more of that.
Thank you, everyone. I think we've maxed out our slot over here. Thank you for letting us stay.